The CEO of the world's biggest bank just issued a quiet warning. Not about stocks, not about the Fed, but about something far more dangerous, a risk building beneath the surface. As long-term bond yields spike and the dollar wobbles, one word is creeping back into global markets: stagflation. Here's what's really happening, and why it could change everything. Jamie Dimon, CEO of JP Morgan Chase, told Bloomberg, "I can't rule out stagflation." He pointed to a dangerous mix: geopolitical instability, fiscal deficits, and persistent price pressures, all colliding at once. And while equity markets look steady, the bond market isn't buying the calm. The yield on the 30-year Treasury just surged past 5.1%, its highest level in over a year. That's not noise, that's a signal. Despite the warnings, the U.S. economy keeps sending mixed signals. Initial jobless claims fell to 227,000, better than expected. That suggests companies aren't rushing to cut staff. But here's the part few talk about. If you lose your job today, it's getting harder to find a new one. Continuing claims, the number of people still filing for unemployment just jumped to 1.9 million, the highest in months. Layoffs may be slow, but recovery is slower. The labor market still supports the economy, but the cushion is getting thinner. Stagflation is the worst of both worlds: high inflation, low growth, and rising unemployment. It's rare, but when it hits, central banks get trapped. Raise rates, you slow the economy further. Cut rates, you fuel even more inflation. It's the nightmare scenario for both markets and policymakers. This is why the spike in long-term bond yields matters. Just recently, a U.S. 20-year Treasury auction failed to attract strong demand, forcing the government to pay higher yields. That's a flashing red light. It suggests investors are uneasy about long-term inflation, deficits, and fiscal stability. When the safest part of the market starts flashing warnings, you should pay attention. Unlike in past cycles, the Fed isn't rushing to react. Dimon agrees, saying a wait-and-see approach is the right move. The economy is still growing, jobs are holding up, and inflation, while sticky, isn't spiraling. That's why the Fed is cautious, but not panicking. Dimon also made a rare comment about the US dollar. "I understand why investors are reducing their dollar exposure. Because when deficits rise and long-term stability weakens, even the world's reserve currency faces pressure. This isn't a crash, but it might be the start of global rotation, from long-term US debt to more flexible alternatives." So what happens next? Watch the shape of the yield curve. It's one of the clearest recession signals in global markets. And it's flashing again. In our next video, we break it down. What is a yield curve, and why it predicts the economy? If you found this breakdown helpful, subscribe to Global Notes by JP. We keep things clear, global, and fact-based. No noise, no drama. Your support helps us keep going, and keeps the real signals coming your way.